Welcome back to my series on Fireside Chats with senior executives from corporate venture funds globally. Today I'm being joined by Heriberto Diarte, who is the founder and CEO of SE Ventures. Harry, welcome and thank you very much. Thank you very much also for hosting us really in front of a fireplace at Harry's wonderful house in Portola Valley. Schneider Electric is a Fortune 500 company founded in the early 1800s and with headquarters in France. Is that correct?
Well, we'd like to think that we don't have a headquarters. We have multi-hubs in different regions of the world. We're a global multi-local company with decision-making centers in Hong Kong, Shanghai, France, Paris, and Zurich and Boston.
Okay. And in terms of business, the parent company provides energy and automation digital solutions for private homes, companies, governments, and so on. Is that correct?
Absolutely.
Okay. And what we will do today, we will dive right into the question on corporate venturing. And Harry, allow me to start with a generic question and play a little bit devil's advocate. Should corporates be in venture capital? Should they dabble in early stage investing?
I would say absolutely. They should be in innovation. And the reason for that is that in the past, the innovation ecosystems were focusing on inventing new industries. The semiconductor, the computer, social media, the mobile phone, many things, social networking. But now the innovation ecosystems are also focusing on disrupting existing industries. The same way that Tesla has disrupted the car industry, Airbnb has disrupted the hospitality industry. Even in traditional risk-averse industries like finance, Lending Club and SoFi and others are making inroads and taking things away from the traditional players. So the innovation ecosystem are disrupting every industry in the world today. And the pace of the disruption is accelerating. So established companies have to embrace innovation. And one of the best ways to do that is to look outside, because the world is smarter than any company. So to have tentacles, antennas, investments everywhere in the innovation ecosystems to stay ahead of the game and to reinvent themselves and disrupt themselves instead of being disrupted.
So what you're saying is they have no option, they have no choice.
Absolutely. I completely agree that if a company doesn't do that, they're going to have their Kodak moment. But if they do it proactively, on the other hand, they can ride the wave of innovation and grow and be very profitable. So it's kind of an all or nothing type of thing.
So as you basically started SE Ventures about 4 years ago, how did you convince the parent company that they had to be in it to win it?
Well, the company was convinced that they had to do something. And they've tried a lot of times. They were looking for a solution, but they didn't know the way to do it properly. So I think the important thing is that after a very lengthy interview process, my interview process with Schneider took 18 months.
Wow.
And I had 19 interviews with 15 different people. So they really wanted to make sure that they hire a special profile who understands big companies but has an entrepreneurial spirit, has an investment experience and can guide them into this. So they were convinced of the need to doing it, but they had failed in the past to embrace the external world for innovation and partnerships. So they were looking for that pilot. Once they got me in, I had 3 months to present to them the roadmap of how do we win, how do we actually do this well. And that was approved. They really liked it and they said, okay, it's full speed ahead. And so they were convinced about the concept of embracing external innovation. What they didn't know is how to do it. And I presented to them a plan, and now we're executing on that.
Okay, so let's go from the why to the how. So the theory or academia has shown many times that the path to successful early stage venture investing means that you have to create deal flow and you need to be able to execute. So SE Ventures, you started in 2017. You have by now, let me get this right, a team of 22 people. You've made 34 investments, and you've had, which is quite impressive, already 3 exits. So tell us, how did you basically get up and running so quickly?
That's a good question. By working really hard. I was employee number 1, and before I had my first hire, I had already deployed $120 million of investment just on my own, doing everything by myself. So to show some early successes and to show the company, look, these are the type of companies we can invest in. These are going to be the financial returns, and look, these are the strategic angle. And so by having some quick, they're not successes, but some quick samples of what we could do, we got the company to say, yeah, that's exactly what I need. That's exactly what I want. I like those sort of things. And they started giving me the trust and the resources to build a team and to make bigger and bigger investments. How did we go so quickly? I think it's because we got the mix right. To do corporate venture right, you need different type of profiles. You need, we have also an incubation practice. So we do incubation, we do direct investments, we do fund of funds, and we also do partnerships. The profile of each of these practices is different.
Sure.
The brains of the organization, the investment team, we're all investment professionals coming from outside the company. But we're complemented with some insiders who know the company really well and who can make the links between what we're doing outside and the investments we're doing with Schneider Electric. So we built a very good team. The people you do it with and the talent is very important. And that helped us to achieve these successes. And also we had a very strong sponsorship from the company, directly from the CEO, who said, I really want to do this. All the signs tell me that it's going in the right way, so I give you the full support. So we had a very strong sponsorship from the CEO, and we were able to spend money or to invest money, to hire people and to do this quickly.
But the conversations with the mothership, with the parent company, is obviously crucial. And that allowed you to fine-tune your path ahead as well.
Well, something that is very crucial is that, most corporate ventures fail. And the average life of a corporate venture is 4 years.
Yep.
And that includes Intel Capital, who's been going for 40. So the real average is like 3.7 years. And GE, for example, just closed for the 5th time GE Ventures. Sure. In this array, they do it exactly the same way. They close it, they took losses, exactly the same thing they've done 5 times in their history. They haven't learned.
So getting it right seems to be complicated.
Getting it right is very important to have the right structure in place and the right values in place. So the initial conversation of how you set up the venture and who is going to manage that and how is super important. And if you do it right, it's like a rocket that goes into the right way, or a small deviation, you go completely the wrong way. So I took a lot of time and very tough conversations to set SC Ventures right. Let me delve into it a bit more.
Sure.
There are 6 deadly sins of corporate venture capital.
Okay, good. 6 deadly sins of
6
corporate
deadly
venture
sins.
capital. I like that.
Yeah.
Go ahead.
The first one is that corporates don't take a long-term approach. Venture is a long-term game. An overnight success takes 5 years.
Yep.
A normal success, for example, in our industry that has to do with hardware and systems and complex industrial things, an overnight success is going to take 7 to 10 years. That's overnight. Normally, it's going to be 10 to 12 years. So the corporate needs to take a very long-term commitment that they're not going to pull the plug 3-4 years later when the first recession comes. The
Sure.
second, they need to have a very strong stomach for a lot of failures. We're going to fail as much as we're going to succeed. And our failures are going to be complete write-offs, right? Where we lose all our money. That's the way venture works. And they need to be prepared for that. And that is against the DNA of most corporates. They like to win and they want certainty. And so they need to be prepared for a long-term approach and for a lot of failures. The third, they need to hire the right talent, to hire the right people that know how to do this and come with a network. And fourth, they need to give these people independence. If they're trying to manage things, this is going to fail. They need to give them the independence to take their own decisions. They give them the playbook. We want you to bring us innovation and to invest in these areas which are strategic for us, and then let them free. And linked to that, they need to incentivize them in the right way, have the right incentives, have carry, so that if they do a great job, these people will make a lot of money. And then you will be able to attract really talented people. And if you align those incentives, they're going to bring you some of the best companies and the best partners for you. And then, lastly, you need to embrace what they bring to the table. The not invented here syndrome, every company has that. The CVC, if they do the job right, they're going to bring to the table some cool companies that can replace some internal R&D projects that you have with some ready-made solution that is probably better than what the company can do. And you can white label that solution, you can resell it, you can do something with that, but the corporate needs to be open to embrace that innovation coming from outside. And in that way, help themselves and help the startups by giving them business. So if you reach that balance of independence on one side on decision making, but on the other one, support and engagement with the companies that the CVC is putting on the table, then it's going to work. You need to have those 6 elements. If you don't have those, it's not going to work.
So there's quite a bit of education involved of that you had to bring to the table and slowly educate the corporate as well and make sure that they're on board, that they are aware of the risk they're taking, because early stage venture investing is risky, right? Statistically, 8 out of 10 deals will fail. And you just need to, basically, you may be able to tweak this a little bit, but you got to be aware of that. And as you said, most corporates are just not ready for that because they're used to M&A deals where we don't have that failure rate.
Exactly. And also those conversations, some of them have been slow, and slowly the company is digesting this, my own company. But some of them at the very beginning were brutal, were very contentious. Let me give you just an example. When I presented in a 4-hour meeting the plan with all the details and what type of profiles I was going to hire and everything else, the company got excited, said, we really like this. This is a great plan. What you're telling us is new for us, but it makes absolute sense.
Sure.
They got excited, and the CFO of the company said, Harry, this is great. I'm going to be there working every week with you in the investment committee, taking decisions side by side with you on where to invest. And I said, no, you're not. Everything that makes you one of the greatest public company CFOs will make you the lousiest investor. I don't want you anywhere there. You shouldn't do that.
It's a different ballgame.
And it's a different ballgame. And I said that to him very openly in front of the rest of the executive committee, and people are looking at me like, who does this guy think he is? I said, look, in the corporate world, we are used to managing the normal curve.
Sure.
Where, by competition and economics, you are pushed to an average return, right? You're pushed to the mean, you're pushed to an average return, and your job is to manage this normal curve to try to get to the right side of that curve.
Yeah.
In venture, the curve is an inverted slope completely that we call seeking alpha, where most of the companies go bust or give you zero return, and a few companies down there give you all the returns and compensate for everything. Managing that curve is completely different to managing the normal curve that most corporate people are used to managing. You need a special skill and experience to do that. So please forgive me, but you will be in the advisory board, we will report to you, but we need the independence to take those decisions and to take some crazy decisions. Because sometimes some of those crazy things that you don't see and you would be against are actually going to be the winners and the disruptors that will change our life. So it was difficult conversations, and he was mad at me for a year. And he was not coming to the quarterly, advisory committees and so on. But then when he started seeing the momentum and the things we're doing, and I was courting him again, he came back to us, and then the situation started working better.
So things are good now. Now, you also decided to set up here in Silicon Valley, not kind of potentially an obvious choice. Did you have help when you look back now 4 years later? What helped you be successful here in the Valley, which doesn't have a reputation of being easy to access for non-locals?
So first, the choice of location. The choice of location is, yes, Schneider is a global company. Our mandate is global. So we had to be in one of the innovation centers, whether it's Shanghai or Shenzhen or Beijing or Berlin or London or Tel Aviv or Silicon Valley. So Silicon Valley is one of the biggest innovation ecosystems. So it makes sense to be based here.
Sure.
And then I was already living here. So it makes it easy for the company to hire me and keep me in my same place. And so that's for the location, but our mandate is global. And how to make it, I'm very blessed because I went to Stanford Business School and I have a lot of friends in the industry, in private equity, in venture. And I spend a lot of time understanding from them and telling them, this is my mission. What are the lessons learned? What have you learned and how to make this right? So I spend hours and countless hours with many people who know how to do this well to get conviction on how I had to do it and how to make it work for a corporate side. And I just want to highlight 3 people that helped me a lot. My friend Nino Marakovic, which is my classmate from Stanford. He's the CEO of Sapphire Ventures, which is SAP's venture group. Arguably one of the most successful corporate venture firms. They have now like 7 billion under management. Nino was instrumental, telling me this is how you do it. And at the beginning, you're going to have these difficult conversations, and then you take it like that. And so he helped me map out the evolution of SC Ventures in a way. Another person that helped me a lot is another GSB grad, Robin Murray, who leads the growth fund of Adam Street Partners.
Yep.
He's a personal friend, so is Nino. And they spend a lot of free time with me, guiding me on how to do this right. And also help me which people to hire, what type of profiles. They send me CVs. They were very helpful. And the third person that I want to thank is Paul Holland, that you met recently, from Foundation Capital. He's a personal friend, a neighbor here in Portola Valley, and he also helped me a lot, and these are the fights you have to fight and set it right from the beginning, because if you don't set it right, you're going to fail.
Yeah.
So have those difficult conversations today, because if not, you're here to win, and that is right. Otherwise, I can go back to private equity and do what I was doing before.
Sure. And let's now have a look at how you're being part of the ecosystem and how you operate in the ecosystem. So we've seen in the last 18 months quite a lot of corporates decide to go into the corporate venture game. And what makes a good co-investor? What makes you basically the first port of call, let's say, for other VCs that may be looking for co-investors, or even for other corporates that may say, hey, we're looking for someone to invest with us?
Okay, that is a very good question. And let's start from the bad news. The bad news is that CVC is the ugly duckling of VC. Is the second tier type of thing. That's the reputation that CVC has. And it's not the go-to for most successful entrepreneurs or other partners. That's the reality. This is slowly changing with a new breed of CVC, like Sapphire Ventures, like Next 47, like M12 from Microsoft, like Google Ventures, like us. Because this new breed of CVCs, we have what we said. We have the independence to take decisions. We have carry. And those two are instrumentally different than your average CVC, because our incentives, economic even, are aligned with entrepreneurs. We want to build great, successful companies, right? And so that gives some comfort to other VCs that we're not letting, for example, the fox in the hen house or whatever. We have incentives to build great companies. That's one important qualification. The other one is, are you able, on the other hand of having that independence, are you able to bring to bear the resources from your corporate? Can you mobilize Schneider Electric or Siemens or Microsoft to support this startup? Can you open doors for them? Can you give them business? Can you become a customer? If you can do that, that is incredibly valuable for the startup. Let me just put it into perspective. Let's say that on year one, the first 12 months, we can increase the sales of a startup by 2 million. If that startup is on the SaaS business at 20 times sales, those 2 million are worth 40 million in value. So the check of 5-10 million we're giving them pales in comparison to the value we can create by actually helping them increase their sales. So if we have an alignment of incentives, if we're able to mobilize, but not talk about it, but really mobilize the resources of our parent company to support the startups, those are two key things. And there are two others. One is when you start having a track record that you're making smart investments, that you know what you're doing, which is already happening with us. They say, okay, these guys are not the ugly duckling. They're already becoming the swan. They know what they're doing. They have domain expertise. They can help the portfolio companies. Hey, I want them around the table. And the last one is that when they start seeing your track record of successes,
sure.
You will get also this aura. And that becomes a virtuous circle. This has taken time. I'm only seeing the signs of that now in the last few months, where people are inviting us. They say, okay, we want to have Schneider Electric around the table. At the beginning, 3.5 years ago, say, no, we don't want corporate money. Entrepreneurs were telling us that. Other ventures, pure ventures were telling, no, we don't want Schneider Electric money. But now they say, no, we want you around the table. And something happened recently that makes me very proud. There was a oversubscribed company in cybersecurity that they were 3 times oversubscribed on the round that they wanted to raise. They increased a little bit the round, but they still were, massively oversubscribed. And many of us said, no, I don't want to have 1 or 2 million. I want to have 5 million or 10, and it's that or nothing. And then the company having 4 choices, including financial VCs, they said, no, I want Schneider Electric. I want them to be on the cap table, to be around the table, because they can help me grow my business.
So they made space for you.
They made space for us.
That was the signal for you that
it's happening.
It's happening.
It's happening.
You're moving in the right direction, and pretty much.
And we're getting that reputation.
Sure.
Slowly.
And what you just said as well is the same thought process for entrepreneurs, because nowadays I'm getting questions from the startups I'm working with. Do we consider corporate venture capital? And how do we separate the good guys from the bad guys, the wheat from the chaff? And it's a good question to ask, because as a good founder nowadays, you will be approached by CVCs. Just looking at the number that we have out there. So basically, find the ones that are independent, the ones that are being paid carry, that are incentivized, the ones that can really open doors for you, not just in terms of pitching, but open doors for you with the corporate, and find also the corporate that's meaningful for you as a startup founder.
Right, absolutely.
So now let's come back again to the internal view. Metrics. We talked about relationship with the mothership. What is your metrics? What are you trying to achieve? Is it purely financial? How will the parent company ultimately judge you, let's say, in another 5 years' time when we get to your decade anniversary?
Okay, good. So we have a double bottom line. We're a double bottom line fund. One is a strategic fit. We are here to invest in and put on the table and partner with companies that can help us create Schneider 2.0. Not Schneider today, but Schneider of 2030, right? And that includes adjacencies, new things that can use some of the assets of the company in some way. So it has to be strategic in some form. And the second one, financial returns. In fact, this is also part of my fight with the CFO. We actually have a hurdle rate before I can see my carry. This is more for private equity, not in venture, but I have a hurdle rate in which I'm incentivized to deliver some certain level of returns. So we have that double bottom line, and I have to say I forgot the other part of the question.
Just basically, what is your, what do you need to report back?
Okay, the metrics, what does success look like? So, first of all, we have a double bottom line. So strategic fit and financial returns. The financial returns is very simple. What is the IRR? What is your MOIC? What is your multiple of capital? Very easy. And we follow that, every 6 months. The second part on the strategic side, we measure it on 3 angles. The first one is, what is the level of sales that are coming from companies that we put on the table, that we partner with, that we're reselling their solution or going to market together or something. The second is, what is the R&D savings that we have achieved by partnering and taking some technology or something from outside that save us time to market or R&D money? That's another metric that we follow. Then, is there a new business qualitatively that we didn't have before? That is, we're going into adjacencies, we're going into things that we haven't thought about it before, but we're utilizing the assets. Let me give you a theoretical example. This is not the case, but we are selling to buildings. The building owners are buying our BMS, they're buying things from Schneider, but we don't have a fire and safety solution. That's Tyco. If I find a company that is doing that, even though we're not in fire and safety, I'm going to invest in it, I'm going to nurture that company, because then we can sell that to our building customers.
Sure.
Right? So it's an adjacency. So that's qualitative and also quantitative, because then we can start measuring the level of sales of that. And we follow also the number of successful pilot projects that we do. We have an obligation to do 5 per year, but we want to do more, as many as possible. And a successful pilot project is when we tested a technology and it works, and then we decide to use that technology to save R&D or to sell it or to do something with it. By now, in these 4 years, we have achieved 50 successful pilot projects, and the level of sales and the level of R&D that we've saved to Schneider can be counted now, already in 4 years, in the hundreds of millions of dollars.
Okay.
Okay, so that's it. And there's another metric. If Schneider ends up acquiring one of our portfolio companies, that and becomes a growth engine part of Schneider, and we can leave it independent, but if it's part of the group and is growing really well, that's another metric that
Okay.
we will count. We don't follow that yearly, but at the end of the life of the fund, we will see, did we buy any of these companies, and are they successful integrations into Schneider? So that is a subset of the new sales that we want to achieve.
Sure. So that's very interesting. Now, as we're coming to the end of our interview, let me give you 2 just very quick rapid fire questions. Are valuations too high in the Valley? You're the one who's paying, you're part of the team that's paying for them. Are valuations too high in 2021?
They're painfully high for the time being, but it doesn't mean you have to wait it out. But if you find a company that is growing at close to 100% and have 80% gross margins, and you feel you can help them hit that product market fit or that inflection point that they can go to market and start growing at this 100%, and they have very good unit economics, you should still invest despite the crazy eye-watering valuations.
Okay, so investors should continue to allocate to venture capital.
Absolutely.
Okay, thank you very much, Heriberto Diarte, who is the founder of Schneider Electric Ventures, who joined us today for the Fireside Chat. If you enjoyed it, subscribe below. We will have more Fireside Chats coming on my channel. Thanks very much.